Good afternoon. This is Robert Rayburn here at Life Pro Asset Management. It is June 12th of 2023. Hope everyone had a great weekend and thank you for joining us. We have a busy agenda. We're 2 days away from the FOMC meeting, the Federal Reserve meeting. But more importantly, perhaps, is what's going to happen tomorrow, which is the CPI, otherwise known as the inflation report. So when we're thinking of the FOMC rate decision and we're thinking about the projected interest rate path between now and the end of the year, that CPI report that comes out tomorrow is going to determine at least how the market perceives that to be between now and the next CPI report in July. And that's going to impact asset class valuations and asset class rotations as we're thinking of growth versus value. What we do know is in the setup into Wednesday, we have growth stocks that have absolutely ripped. Valuations are incredibly extreme, right back to those extreme valuations of 2021. Meanwhile, value stocks are almost 2 standard deviations cheap relative to growth. And we haven't seen that since really the last year and a half or so. So we think actually value stocks are pretty well set up here as it relates to price, as it relates to short-term trading action, but most importantly, as it relates to the valuation of really good businesses. So that's the part of the market that we're liking, regardless of that FOMC rate decision. So this week, what are we focusing on? We're going to focus on 3 big things. Number one, what are the latest signs from the economy? We haven't talked about that for a bit, so let's get an economic update. What's the labor market telling us? What are some of those leading indicators for inflation telling us ahead of Tuesday's reports? You'll notice last week was pretty quiet, and that's why, because we got inflation this week and we got the Federal Reserve this week. Number 2, Wall Street is increasingly bearish. What does this mean? When we think of recession fears, when we think of inflation fears and interest rate fears, a lot of that is known and it is baked into a lot of numbers across Wall Street. So we have to really understand, is it worse than those assumptions, or is it a little bit better and priced in, or just flat out better? And so that impacts how we look at risk and how we determine where in the market we want to invest in. And lastly, if that technology bubble does pop, and as you guys know, those people who are watching our updates on a weekly basis, we believe that the very top of the market here, as dominated by FANG stocks, Facebook, Apple, Netflix, Google, Nvidia, etc., that is a bubble. We know a bubble when we see it, and that smells and looks and tastes like a bubble. So now, when we think of the most important chart, we brought this chart up last week. We're bringing it up again. We'll probably bring it up again next week. With the 2020s, when we look back in 2030, we think that this will be the chart that everyone looks back and says, this was the most important chart of the decade. That commodities to equity ratio. The last time that commodities were this cheap was way back when the tech bubble burst in 2000. We think that's a pretty fortuitous sign as it relates to what's happening today. That tech bubble burst, we did get a good year from commodities last year. We've had a pullback. And so we now have a second opportunity to really take control and really take advantage of this generational shift that we think is taking place away from equities and toward commodities. Really, another way to think about it is away from your traditional equities and toward your commodity-based equities. I think that's probably a better way to phrase that. Now, we did get a very nice and healthy labor market report back in the first week of June. We saw 339,000 jobs created versus 195,000 expected. But that was also paired up with a relatively benign hourly earnings figure. So we saw hourly earnings rise 4.3% year over year. That has started to drop over the last few months. That's a good sign as it relates to more sticky inflation. 4.4 was that expectation. But here's the thing. So wage growth came in later than expected. We obviously see that job machine is continuing to crank out jobs. But does it necessarily mean the economy is fully in the clear? And that's not necessarily the case, right? But the first thing is inflation, right? We got the inflation report coming out on Tuesday. And what we noticed here is this is your core CPI year over year. And again, you can do 1,000 of these overlay charts and look like a total goof the day the report comes out. But I will say this, the ISM services prices paid has really started to drop. Now, this is a subsegment within the ISM services report, which measures service level economic activity in the US. And within that report, you get a prices paid report. This has really come down. And so if CPI does follow the historical trend of following the ISM services prices paid, that could suggest potentially that inflation could actually start to drop here more than people realize. And the other thing I wanted to point out is the Fed has started to signal that they may shift their inflation target. So they've been very strict around the 2% inflation target, but now you're starting to get word that the inflation target is going to be widened out to 1.5 to 2.5. Now, to you and I, that may not seem like a lot. What's half a point to the upside, half a point to the downside? But what that's really saying is the Fed may be getting a little bit more worried about the economy relative to inflation and is willing to stomach a little bit higher inflation than they have in the past in order to not destroy the economy. And if that's the case, are we going to be in an environment where inflation is just structurally higher than 2%? In other words, 3-4% versus 0 to 1.5 or 2% the 10 years prior? That has a huge implication as how we think about gold and how we think about technology and growth stocks and value stocks and commodities, et cetera. In our opinion, that would really be a huge advantage for gold and commodities, as well as value stocks, because that's going to drive higher nominal economic growth, even though it's paired up with higher inflation. And that's generally good for value over growth stocks. And when we think of that recession watch, the one thing I do want to point out is, yes, that labor market was good, but we have seen a pretty big tick higher here in U.S. jobless claims. Not a lot of people are talking about it. I do want to pay attention a little bit to this. We did get to 261,000 weekly jobless claims. That's the highest level that we've seen since 2021. So again, two reports that are saying two different things. The jobless claims report here tends to be a little bit more high frequency or a little bit more leading in nature. So again, yes, that was a very healthy labor market report, but there was weakness in that labor wage growth number, which is good as it relates to inflation, not so good if it relates to the jobs market. And then we see this jobless claims number, and I think that is a little bit of a red flag that we do want to pay attention to. As it relates to that recession checklist, capital goods orders remains okay, but consumer expectations, single unit housing permits, the inversion in the yield curve, ISM new orders, all of these things suggest that there is weakness there in the economy. A lot of it is priced in, right? And we're going to go through the next chart, but it is something we want to watch. I think that's important because sometimes recessions can take longer to arrive than we realize. So even though we think that there's opportunities in the market, we also want to be careful about avoiding some of the pitfalls as well. Now, in this particular one, we see so bearish, it's bullish. So this is a chart that one of our research partners have put together, but you can see here, 4,300 is where the S&P is trading at right now, give or take. When we look at all this major Wall Street strategists, every single one, with the exception of one or two, is below this number. So what is that telling us? That tells us that Wall Street is very bearish. And all you have to do is go on Twitter and spend 10 or 15 minutes on there to get a sense of it's not just Wall Street, but Main Street as well, that is very, very bearish relative to what actually are fairly decent corporate earnings. So there is this disparity between the real world, the corporate earnings world, and the perception of that. And we don't want to discount perception because perception can sometimes become reality, right? But there is a lot of negativity priced into the tape. We want to be aware of that. We want to be cognizant of that when we're thinking of our own portfolios and not necessarily get sucked into the crowd, right? And that's really the main issue here. So it's been a race to the bottom. And when the crowd is bearish, we always ask that question, what can go wrong? And what can go wrong is you can get assets that rotate the other way. Now, the one part of the market that hasn't been bearish has been technology. And when we think of technology, you're really getting signs of an intensifying bubble. So we focused a lot on NVIDIA last week, and I want to continue to focus on NVIDIA, but it's not just NVIDIA. When we look at Avago or Marvell, or we look at Facebook or Google, we're not just seeing parabolic moves in the stock prices, but the amount of volume traded in these stocks is incredibly high, right? So we call these blow-off tops in Wall Street parlance. In other words, there's this panic buying, and that usually happens right at the peak of a move. And you can see that happen not just with NVIDIA last week, but Avago. You went from an average of maybe 8 billion traded per day to 29 billion. And in NVIDIA, you went from, call it, 80 billion, or sorry, 50 billion to 132 billion traded in a day, 99.5 billion traded in Marvell, way above the average here. You can see by the chart, picture says 1,000 words. And then the record weekly inflows into tech. So all of this just kind of shows this panic. I have to buy it. I have to own it. I cannot wait. That's where we need to be careful. We need to be super, super careful. And so what are the implications of a narrow market? Now, a lot of times people can say it can be bearish. But I would sometimes take the other side of it. When you look at the S&P 500, the S&P 493 has largely been flat to down for the year. The S&P 500, as dominated by 7 stocks, has been positive, right? So the 7 stocks have pulled up the index. Well, what happens if you have a situation where the 7 stocks implode, but then the 493 start to catch up? You get this convergence to the mean. That kind of means that what everyone's stuffed in right now, those 7 stocks, are going to lose people money, and the 493, the boring average stock, may actually start to outperform. And that's kind of how we've been looking at the portfolios, and how we've been looking at the market is, what are those average stocks in energy or golds or consumer or industrials that we can pick away at here at relatively attractive levels? In other words, we want to skate to where we think the cash is going to go. Recession is coming, right? Everyone's been fearful of that. So in a way, what they've done, what investors have done, is sell everything and buy FANG, Facebook, Apple, Netflix, Google, the stuff with rock solid balance sheets, lots of cash, you can't go wrong. Okay, but NVIDIA is trading at 156 times earnings. So what happens when the economy is not imploding and people say, oh, wait, there's like those 493 stocks and the rest of the index that I can buy, the Russell 2000 and 2000 stocks there that I can buy, the Russell 1000 and the growth stocks that I can buy there, or the value stocks that I can buy in the Russell 1000. That cash starts to sell. They need money to buy those stocks. So they sell FANG. So in other words, we don't want to wait for 2 years from now where we say, oh, we're in this industrial revolution or we're in this commodities bull market. Let's look at where the crowd is today and say, where can we pick up some of that opportunity? So in other words, as cash leaves tech, it pushes the rest of the market upward because it's chasing the average stock. And we think that counteroffensive has already begun. When you look at technology, they are showing some signs of exhaustion. And just as important, Russell 2000 had a pretty strong breakout this week or last week. And then the energy sector relative to technology showed signs of trying to make a turn. And the rolling 3-month percentage change of energy versus technology was 99% out to the downside at the beginning of last week. That has started to turn. We love energy here. It's our biggest overweight. We're high conviction bulls over a long period of time. When we look at the market share, in other words, what is the S&P 500 weight of energy? It's something around 4%. But the earnings market share of energy for the S&P 500 is like 12%. So there's this huge disparity between earnings market share and stock price market share. We think the stock catches up to the earnings market share. So bottom line here is, as fear over the economy subsides a little bit, we think the cash that are hiding in FANG stocks are going to flow into the rest of the market. 3 big takeaways. Job creation remains strong, but those jobless claims are rising. I want people to pay attention to that and just follow that week on week. Nothing to panic about. I just think we need to follow it. Number 2, we believe market breadth, while it has never been so narrow, may very well start to expand as the average stock starts to outperform FANG. And then lastly, if that hyper bubble at the top of mega tech deflates, we do think that the average stock, most importantly, energy and commodities, will benefit quite a bit. So that's what we got for you this week. It was a pretty quiet week, to be perfectly honest, but it's going to be a very interesting week this week as it relates to the Fed, CPI, and other earnings reports as we see here across the market. So stay tuned, and we'll be back next week. Talk to you later.